Control and compound. Why the rich use insurance to build generational wealth. The Truth About Real Estate Investing show, and me as host of the show, Erwin Cito, welcomes Canadian Darren Mitchell from Halifax, Nova Scotia, CEO of Control and Compound Financial, published author and nationally respected expert in cash value life insurance strategies for Canadian business owners and real estate investors. With over 19 years of experience as a financial advisor and 2 best-selling books under his belt, Be the Bank and Infinite Banking for Canadian real estate investors, Darren has helped countless Canadians take control of their capital using whole life insurance to create scalable, tax-efficient wealth. His journey into cash value insurance began during the 2008 financial crisis when he realized that he, and more importantly his clients, had no control over their money. Since then, he's been on a mission to educate Canadians on how the wealthy leverage these policies to self-finance real estate, business growth, and even retirement, all while avoiding the pitfalls of traditional financial planning. In this episode, we'll dive into how to know if cash value insurance is right for you, because Darren's the first to admit it's not right for everyone, the real mechanics behind tax-free growth, tax-free access, and tax-free transfer of wealth, real examples of how Darren and his clients are using their policies for down payments, corporate planning, and even bucket list retirement goals. If you're already successful or plan to be successful and don't want to pay CRA more than you have to, you'll want to give this episode a listen. Darren also runs free educational webinars monthly, where you can find them at www.controlandcompound.com. That's control and it's spelled out, controlandcompound.com. You'll also find links to his books and podcasts there. And if you need help in being a more successful real estate investor, make sure to attend one of my upcoming events, such as how to maximize your returns selling an investment property, what's the best investment, and my favorite, the iWin meetings, because they're in person. I love in-person meetings, and they're online as well. We don't want to ignore anyone that's not within a reasonable driving distance of my office in Oakville. And lunch is provided, thanks to my sponsors. And I love the fact that lunch is provided because I honestly love networking. Stay tuned to your emails, and I hope to see you at an upcoming event. If you'd like me to book me for a Zoom, there's also a link to book me in the show notes. Please enjoy the show. But before we get to our guests, I want to take a quick second to share something valuable with you. If you're serious about building wealth through real estate but struggling to find profitable investments in Canada, I've got something that will help. I've put together a comprehensive guide to U.S. real estate investing for Canadians, breaking down the best markets, financing strategies, tax considerations, and landlord-friendly states where Canadians are getting better cash flow and long-term appreciation. It's completely free. You can grab your copy at www.truthAboutRealEstateInvesting.ca. Just look for it on the right side of the page. Along with the guide, you'll also get our weekly newsletter that goes out to over 10,000 Canadians at no charge since 2010. Yes, I've been sending it for every week since 2010. We send new podcast episodes as they're released, so you never miss out on these expert insights, invites to exclusive in-person and online events with top real estate minds, actionable strategies to help you grow your portfolio and build wealth faster. Again, go to www.truthAboutRealEstateInvesting.ca and download your free guide today. Now, please enjoy the show. Hi, Darren. Thanks for coming in.
Thanks for having me. Excited to be here.
You came all the way from Halifax.
Well, I came from Mississauga today, but yeah, Halifax. I came up last week from Halifax. Yes.
So, what's keeping you busy these days?
Cash value life insurance. We're business is growing. We're expanding like crazy, hiring new people, expanding our markets, and I was up for a couple days of coaching class with my group, and saw some clients, and lucky enough to come see you.
Well, thanks for coming all this way. Now, tell us about how you got to cash value insurance, because I think your journey is quite interesting, because you've been at this for quite a while.
Yeah, I started, I just started just down the road here back in the 90s when I graduated from university. I worked on North Service Road in Burlington on the pension and group benefits. And then about 19 years ago, I started my own practice, became financial advisor with my own shop. And that was a little scary to, a 2 and a 4-year-old, and explaining to my wife how my income was going from a nice corporate income to zero. And then did traditional financial planning. Really, I did some insurance, I did investments, I did like every other financial advisor, I'd do everything. And then 2008 was really when the pivot in my career. I was salmon fishing in Alaska, trip of a lifetime with my buddy up there fishing. I had to convince my wife to learn how to put hockey gear on my 5-year-old boy at the time, and that's when the market crashed, the fall of 2008. And I realized I was not in control of my money, but more importantly, not in control of my clients' money. And that's really when I went on an education crusade. Literally for 2 years, I traveled around North America and I learned how come the wealthy made so much money in 2008 and how come the middle class lost so much money. And that led me really down to this path of cash value life insurance, whole life as a place to put a portion of your money and leverage it for in good times and bad, emergency fund, and the death benefit too. But really, it was the access and control of your money, and that's when I really made the pivot to say, okay, this is what I want to do because I'm not going to go through 2008 again with my clients. I was in my 30s at the time, no big deal, but I had clients in their 50s, 60s, 70s, and I didn't have a good story for them. So ever since then, it's been cash value life insurance has been our focus. That's all we do now. And now we work across Canada with business owners, real estate investors, individuals, uh, helping them implement the infinite banking concept, or really not necessarily exactly that, but cash value life insurance as a place to store and save your money.
So let's start off with because there's also critics of these products as well. So
Yeah.
can we start with who is this not right for?
Yeah, I don't think this is for everyone at all, and I think that's unfortunately one of the things in my industry is, the expression our industry with some guys is, if you can fog a mirror, you're perfect for this strategy,
Yeah,
and I disagree with
and
that.
I love the like everyone's your potential client.
Yeah.
Like,
So where I think it's really not applicable, I don't think if you can't save if you're not saving $10,000 a year right now, then I don't think you're ready for this concept because I think you need to go back and invest in you and your skills, maybe look at a budget or something to get your expenses either under control or more importantly, I'd like your income up. So invest in you, get a coach, join a real estate group, whatever you're going to do to make yourself better. Where I really struggle when clients come in is, you have somebody that's 30, 35 years old, maybe making 80, 100 grand, spouse at home with a couple little kids, and someone has sold them a whole life policy because of all this great cash value for, I don't know, 500 bucks a month or something. And I look, and the death benefit on that might be 200,000.
right.
And I'm like, if you get run over by a car today, what is your spouse and 3 little kids gonna do with
Yeah,
$200,000?
especially if you have a big mortgage still.
Yeah, so I look at people like that and I'm like, "Listen, you need a couple $1,000,000 of term insurance for 30, $50 a month or cheap, whatever it is, and then you need to work on increasing your income and decreasing your expenses."
Mhm.
And some of the people in my industry will say, "Oh, no, no, you need whole life." And I think that's the challenge. So, you know, I don't think this is for everyone. If you're I always joke, I don't have a lot of teacher clients. In fact, I only have one and I had to marry her. So,
So it took a lot of convincing.
yeah, if you got a defined benefit pension plan and you're looking to throw an extra $100 a month into savings for that, this isn't for you. I think it's perfect for real estate investors and business owners and people that are in a higher income tax bracket.
Right. And probably people that generate significant cash flow. If they're
Yeah.
going to be a real estate investor, they're going to probably have to generate significant cash flow in order to afford this.
Yeah, and your cash has to reside somewhere. And my first book's called Be the Bank, and I would argue, why not put it in your own bank instead of someone else's bank?
Hmm.
So you're in control of your own bank. You set the terms of the loans. You decide when, how, and if you pay it back. So there's huge advantages for
Hmm.
real estate investors, especially.
So my wife are business owners, and we're real estate property owners, and all those sorts of things. And the way she always frames it for people is like we all need insurance. We specifically need insurance because we have debts on businesses and properties and whatnot. So we need insurance to pay that because just we talked about you mentioned control earlier. We don't want our assets to be sold upon death, right? We'd like to see continuity for our businesses and our properties that they wouldn't have to be sold to pay off the tax bill when we pass. So for many people, you need insurance, and then this whole concept that it keeps going up in value. Can you explain that? How does one's insurance value go up in value and then in turn increase your net worth and be an investment essentially?
Yeah, so when we talk about traditional insurance, like a term insurance or a term to
Right,
100 or just standard universal life,
right. Because
it's
that
re
is what, like, most people have.
100%.
Yeah, and included in, like, company plans. Does
So
anyone's company plan have whole life
no,
insurance? Oh,
no,
nobody.
nobody's company plan.
Right. So this is not a common, it's not like a household thing.
No, so in Canada, there's about 10,000 different insurance products available.
That's a lot.
And of the 10,000 that are available, there's 4 specific products that we can use for this. So 4 out of 10,000. So when people come up to me and say, insurance is just an expense, I'm like, yeah, I'm with you on 99.9% of the policies out there. So if it's one of the four type of policies that
Mhm.
we can offer, that we offer, they're the only 4 we offer. Um, the difference is now you've got 2 tall columns. You've got a cash value column, which is really your savings or where you're going to store your wealth, and you have a death benefit. And both of these are guaranteed to go up every year. So there's a couple components to the guarantee. So let's say your cash value is 100 and your death benefit is 500. Well, at the end of every year, they're going to say, we are going to guarantee that your cash value doesn't go down. And that's contractual. That's not just them saying, oh, it never goes down. It's contractually guaranteed never to go down every single year for one company going back to 1846, but for the other 3, at least 100 years since they've started this policy, they've paid a dividend. So the guaranteed to go up even if they don't pay a dividend. But the key is they've always paid a dividend. And once you get the dividend, it can't go down. So my example, if your 100 grows to 106 the next year, well, if the stock market crashes 30%, if that was in the stock market, you're down to 70 some grand. This, you're guaranteed not to go down from the 106 and you're guaranteed to go up the next year. So that's an incredible place to be in control of your money. And that's our whole thing.
Mhm.
Control and compound. There's a reason we're called control and compound. I think if you're a real estate investor, you're a business owner, you're a wealthy individual, you've got to be in control of your money because I promise you, there's going to be financial emergencies come your way and there's going to be financial opportunities come your way. And your ability to deal with those opportunities and
Right,
emergencies are fundamentally going to change your financial life forever.
right. And anyone who hasn't had those hasn't been in business long enough,
Exactly.
including landlords. Like, yeah, no different. Like there'll be times for opportunity, kind of like nowish. A lot
Yeah.
of opportunity now, and there will be cash calls.
Yeah. So I was, I remember in this education crusade I went on, I was down in Florida at a conference and this accountant's talking. And he's talking, he goes, I don't sell insurance, but he goes, all my clients pretty wealthy business owners. And he goes, in 2008, when the market crashed, nobody could access money, nobody could get a loan. Stock market was down 30 or 40, real estate was down 30 or 40. And he goes, I had this one client who had this cash value life insurance policy and he borrowed over $1 million from it. And he bought 13 additional businesses for 30 cents on the dollar.
Mm.
And he goes, he 10x'd his wealth in 4 years. And it was always some smart aleck puts his hand up and goes, what was the interest rate on that loan? And the accountant's like, who gives a crap?
You bought
He
30 cents on a
10x'd
dollar.
his income. And, it
Yeah.
was probably 6 or 7% at the time.
Mhm.
But, people get hung up on all these little things, but they miss the big picture. And the big picture is control of your money. If you're a real estate investor and you got a deal of a lifetime happening, you need money quickly. And the ability to access money, no questions asked. I mean, the loans on cash value life insurance, we call them the holy grail of loans. So the loans, number one, they're tax deductible, the interest on them, if you use it for an investment purpose. Okay. They're uncallable. So, not like a line of credit, not like if you lose your job, the tenant stop paying, the deal goes. So they can't call the loan. And you have the ability to repay that loan when, how, and if you want,
Mhm.
because the insurance company, if you have an outstanding loan, go back to an example with 100,000 of cash value and 500,000 a death benefit. If I borrow $90,000 to go buy a real estate property and I don't repay that loan, they're just going to subtract that from the death benefit. So they know they're going to get paid. Insurance companies are in this for the long haul. They know you're going to die, 100% chance.
Mhm.
So that ability to repay the loan when, how, and if you want for business owners and real estate investors, that's why I think it's a perfect strategy.
Mhm.
And when you take that loan, sticking with that example, if you have 100,000 in cash value, you borrow 90,000 with a $500,000 death benefit. Well, your 100,000 is still 100% in the policy
Mhm.
because you didn't cash out your policy, you borrowed against it. And that guaranteed loan up to 90%, no questions asked. The only person that needs to approve the loan is the person in the mirror. If guy in the mirror in the morning says good to go, you're good to go. So you borrow that money, you have a plan to pay it back over X amount of months or years, or you don't make any payments for the next 2 years if you're doing a lift on a property or something, you're going to refinance it. That flexibility is incredible for real estate investors. And we can get into the whole how it affects your borrowing capacity as well. It's amazing.
The first thing that came to my mind is like, can you give me like accounting analogy? Would this policy like be an asset essentially?
Yeah,
Yeah.
100%. And that kind of leads to what I was hinted at a second ago. So it's considered an asset. So let's say I bought a fourplex in Cornwall a couple years ago. It was like, I don't know, 375 grand. So I needed $80,000 for the down payment roughly. So my kids at the time were teenagers, and I'm big believer in brainwashing children early about money. So I've always tried to teach my kids about money. So I go, all right, kids, great opportunity, great cash flow, great appreciation opportunity. I need 80 grand. Can I get that for my RSPs? And they're like, no, dad, that money's in prison. Like, all right, good. They're listening. What about your RESPs? No. I go, well, I have this beautiful cash value life insurance policy. I go, why don't I leave that there? And why don't I use the insurance company's money? So I went to the insurance company and I said, hey, I need 80 grand.
Right.
And they said, Darren, would you like a check or would you like it deposited in your bank account?
Right. No
They did,
questions asked,
they
really.
didn't ask me what it was for. They
Yeah.
didn't ask me when I was paying it back. They didn't ask me if it was a good deal. They didn't ask for financials. They just said yes. So then I went to one of the big,
It's nothing like going to the bank.
no. So then I went to the bank
Yeah.
and I said, hey, I need a mortgage for $300,000 for this fourplex. And they said, where'd you get the down payment? And I said, I borrowed against my cash value. And they said, cool. We don't consider that a loan for borrowing purposes because technically I could have canceled my policy and taken the $100,000 cash.
Mhm.
So they consider it an asset. Now, that's not a good strategy to cancel it because now by borrowing it, I still have 100,000 in my cash value or whatever it was at the time, continuing to compound tax free, and I have the real estate deal done now, and I have a death benefit, and the cash value and death benefit are going to increase every single year till the time I'm dead.
Mhm.
So what I did on that property is it was actually two duplexes on one lot, interestingly enough. So it was a lot of people couldn't get financing for it. And, again, because I had access to quick money with the cash value. So we actually went to the town and we severed the property into two separate properties. And then the value now, all of a sudden, a couple of years later, was like 320. So we refinanced one of them,
Sorry, 320 each?
320 each. Yeah.
And you bought for under 400.
Yeah. We bought it under 400. So we refinanced it, paid off my policy loan,
With cheaper money, yeah.
cheaper money,
Yeah.
cash. Now it's still cash flowing with the slightly higher mortgage. And that didn't affect if you look back a couple of years, that didn't affect my growth of my cash value at all. My cash value grew exactly the same whether I'd taken that loan or not take the loan. So we call that an and asset. Money's in the policy growing and it's outside doing the real estate and it's providing a death benefit. We've multiplied money kind of like a bank.
Mhm. I have so many questions. So imagine you've answered this before, because there's many assets you can borrow against. Like real estate generally is the cheapest you can borrow against.
Yep.
And then if you have enough gold, you can borrow against it. You can borrow, I think, off a stock portfolio as well. Where would the whole like policy rank in terms of assets that you can borrow against based on interest rate?
Yeah. So let's talk about two components of that.
Sure.
So number one, it's the best asset to borrow against, and I would argue for the first reason, the percentage you can borrow, and the flexibility of the loan. So let's talk about stock market. Sure, I can borrow against a stock market portfolio. You might be able to get 50%. Because why? Well, because there's volatility in the stock market. If you got $1 million in your portfolio, and all of a sudden the market's down 30%, well, now you only have 700. So you could be in a situation where the lender
Cash
is saying
flow, yeah.
cash, yeah, the
Or
lender's like,
margin
we don't
call.
like this margin call.
Yeah.
So in that situation, 100% you have a margin call. Same thing can happen with real estate. Less likely in real estate, but you could have a drop in the market, and you could have real estate. But the real estate place, the tenants could trash the place could burn. Real estate could go down in value, not long term, but short term could go down in value. So they're going, all right, we're going to loan you 60 to 80% typically
Right.
in real estate.
Yeah.
But then we jump to this cash value, and they're loaning you 90%. Now, the insurance companies aren't dumb. Why would the insurance company loan you 90% and only 50% on a stock market portfolio and 60 to 80 on real estate? Because that asset is guaranteed to go up. They know with certainty, if you have 100 grand today, you're going to have more than 100 grand next year and more than 100 and whatever your growth was year one to year two. So they know with certainty, A, it's going to go up in value, and B, they know with certainty, again, you're going to die.
Mm-hmm.
So if you don't repay the loan, they don't mind charging interest on that for the next 30 years because they know the death benefit is always going to be higher than the cash value, and the cash value is always going to be higher than the loan. So there's always going to be a spread there when you die that your family's still going to get some tax-free money. So as far as that, the first part of this equation, 100% cash value life insurance, I think is the best place to borrow for certain things. It's not the best place to borrow for, the 80% of the mortgage you go get, which brings me to your question was, what is the interest rates? So the interest rate typically today is going to be somewhere around 6 to 7%. As interest rates drop, we're going to see that drop. 2.5 years ago, it was down at around 4.75.
Right.
So somewhere between, 5 and 6.5, 7 today,
Right.
is what we're borrowing. But again, I think it's the perfect thing to borrow for for certain things. But that flexibility to be able to say guaranteed loan, no questions asked, pay it back when, how, and if you want. Because you're typically not borrowing for a 25, 30-year period like a mortgage. When you're borrowing for a 25, 30-year period, 100%, that interest rate is really important. The interest rate isn't that important when you're borrowing for a year or two to do a deal. Because typically our real estate investors, they're looking to get 20, 25% or more on the opportunity. So to borrow at 6% or 6.5%, that it tax deductible. So it's going to cost you three point something after tax. And you're going to go make, 20 or 25, maybe even a return of capital there where you're not paying tax on that or deferring the tax. It makes sense all day long to borrow for down payments, to borrow for real estate deals, not to borrow for mortgages. There's some in my industry that think, oh, I have a $500,000, I borrowed 500,000 and I have no mortgage now on this property. I think that's a horrendous use of cash value life insurance. I would say, well, why don't you borrow 500,000 and use 100,000 to buy 5 properties instead of one, and you're going to have lower interest rate on, the 80% you get the financing on. So again, not for your whole mortgage, but for down payments, it's great. For private loans, it's perfect. For doing lifts in properties, sometimes those are hard to get loans for. You buy a property and you want to throw 100 grand in to increase the value, add a unit or whatever. Again, no questions asked. And oftentimes, I don't know if you've experienced this, oh, it's only going to take 4 months to fix this place up. And all of a sudden you're 6, 7, 8, 9, 10. Well, again, that ability to say, you know what? I'm not going to repay the loan in 6 months. I'm going to defer it till 9 months or 10 months. And then I'm not going to repay all of it. I'm only going to pay back some of it. Or you run into trouble. That's the other cool thing. While you're using that money, your cash value is continuing to grow. So let's say you had 100 grand in there, you borrow 60 grand to do a lift on a property. The deal doesn't go as well as you expect. You don't pay back the 60 grand, and now you go borrow additional money. And you say, well, now my 100 is worth 110 or 106 after a year. I'm going to borrow an extra 25 grand to finish this because it's more expensive than I thought. And you're not going to a bank. You're not going to private money. You're not begging for money. You're looking at the guy in the mirror and saying, hey, I need an extra 20, 30 grand, and I'm not going to repay it for another year or two. No problem.
Because people private borrow for like 8 to 15 to more percent and lender fees.
And it's getting tougher to get private money today
Very
too.
tough in today's market. A lot of people lost their shirts.
Yeah.
So just to go back to like where it ranks, like based on LTV, like this is the base LTV loan to value. It kind of indicates it's the lowest risk of the assets you can borrow against, just based on loan to value, because no
100%.
real estate goes to 90%. And then on rate, I think we're just behind Schedule A financing on real estate in terms of rate. Because just on top of my head, like I've had B lender mortgages and paying 8 to 10%.
Yeah.
So this is cheaper than B lender mortgages on real estate.
And no penalty to prepay it, right? So, you borrow it and you get a B mortgage, and all of a sudden in 2 years, you can go get an A mortgage or whatever, whenever you can refinance. Great. You pay that loan back when you want, how you want, and if you want. So again, that flexibility to choose when you repay that loan. Now, I will caution people back to who this shouldn't be for. If your idea is, you're 35 years old and you're going to borrow the maximum you can against this and choose never to pay it back, well, I don't think that's a great strategy too. I would say we're going to borrow that money, have a plan to pay it back. And my kind of rule of thumb is if I'm doing a deal where I know in the next 24 months, I'm going to get my money back or get the money back to pay off the loan,
Short-term money. Yeah.
I probably won't I probably won't even make a payment on the loan. But if I'm doing something and say we're going to refinance property in 5 years, I'm probably going to pay the interest on that just because, just like the compound growth of the policy, we call it the compound snowball. It's like you roll a snowball for the rest of your life. Think how big that snowball would be. Well, that's uninterrupted compounding, not interrupted by taxes, fees, volatility, or spending, right? Spending is the big one where you roll the snowball and then you pay cash for a down payment. Well, you got to start with a new snowball. With cash value, you never roll that snowball. So, you're going to borrow for the deal, pay it back in the short term until you hit retirement. And that's the other kind of sexy part of this is when you hit retirement, let's say, you're putting 20 or 25 grand a year in, you're growing it, you borrow against it 10 times. And you do all these different real estate or business or deals, or you bought Bitcoin when it was a sale, or even you bought the stock market when it was down 40%, whatever opportunity you saw and took advantage of, you made the decision whether it's good opportunity, not someone loaning you that might have to loan you money. And you come to me at 65 or 60 or 70, whatever, and you go, Darren, cool, this worked great. I grew my money tax free. I was able to take advantage of 10 opportunities. I'm a lot wealthier than I would have been if we didn't cross paths. But I'm in my 60s now. I don't want to do any more deals. I don't want to borrow money and pay it back. Like, what do I do with this thing now? And then it's the kind of second phase of what we call retirement mountain. The first phase is you're climbing a retirement mountain. You're saving, you're accumulating, you're building. Well, the second phase is you're basically distributing the money. So in the second phase, let's say now your cash value is $1 million. Well, why don't we take, I don't know, 80 or 100 grand a year loan in retirement on that? Again, I mentioned loan. Why loan? Because A, that loan is completely tax free. So let's say we get a $100,000 loan coming in each year, and we're never going to pay that interest and never repay the loan. And you have that flexibility. And the cool part of this is you can continue to borrow that $100,000 a year in retirement. Your cash value continues to compound. So your $1 million of cash value is going to be worth, 2 million in 12 years. It's going to be worth 4 million down another 25 years. So your cash value continues to compound. If we go back to traditional financial planning, if you save $1 million in the stock market and you retire, most people are spending principal and interest, principal and growth. So they're going, the next year we have 950, 900, 800, 750. So you're getting less and less compounding. We're staying on that compound curve for an extra 30 years of retirement. So our million is continuing to grow. So those loans, when you do the math, what you can borrow against in retirement is going to be way better than traditional financial planning because you never stop that compound growth and it's tax free. So then fast forward, I did that for 10 years, 15 years. I die. There's $1 million outstanding, maybe $1.2 million with outstanding interest. But the death benefits now had 40 years to compound. The death benefit didn't start huge, but by year 20, 30, 40, now say the death benefit's $3 million, 3.2 million. Okay. My wife's going to get a call saying, hey, here's $3.2 million death benefit. We're just going to subtract $1.2 million for the outstanding loan that you and your husband spent in his lifetime. Here's a check for $2 million. So again, tax-free growth,
Yeah.
tax-free loans, tax-free retirement, tax-free death benefit. And that's really just personal. And we get into the corporate, it gets even sexier.
I wish they had taught this in school to motivate people to make more money. Because the whole time we've been talking, I've been thinking like this is one of the strategies how the rich get richer.
100%. And you look
Because
at,
if you can't afford this, you can't take advantage.
yeah, I mean, people say, "Why haven't I heard about this before? It sounds too good to be true." And I'm like, there's like $1.4 billion of new money goes into this every single year in Canada. And if you look at some of the wealthiest families, the wealthiest business owners and real estate investors, this is the strategy they're using. There's lots of wealthy families that when you turn
Yeah.
18, the first thing they do is buy a massive whole life. You look at, Arnie Patterson's a big one. Toronto here, Ted Rogers. Ted Rogers had, I think the story was 47 loans against his cash value to grow Rogers Communications, because he couldn't get financing. Walt Disney, he told the story when he was live. Maybe it's just his head's telling the story now that's frozen. Walt Disney goes, you want to see a banker laugh, you go in and say, I'd like to start something called a magical kingdom, and we're going to have castles and princesses, and people are going to come from all over the world.
Giant mice, screaming
Yeah.
people.
He
Everyone's
goes,
gonna want to hug them.
they laughed me out of the office. And he goes, I borrowed from my cash value to start Walt Disney. And that's how he was able to do it. So the wealthy have been doing this forever. But it's similar to the strategy you hear about what wealthy people do now, like the Musks and the Bezos, where they don't actually cash out. Jeff Bezos doesn't cash out his Amazon stock.
Yeah.
He borrows against the value because he's confident it's continued to increase in value, and that loan is tax free. Well, we're all not Jeff Bezos, but we can all do cash value life insurance and have that same type of strategy where you never stop the growth of your tax free cash value.
Mhm.
You never stop the growth of your death benefit, but you're still able to use money.
We were talking about this before we started recording about because I only learned about this more recently was that this is really effective for people who have corporations.
Yeah.
So they have typically they have successful businesses, so the cash flow they can easily afford for these policies, and then they can again, in a corporation there's sheltered income, and now they can borrow against it. And then just because I want to share it with you, because I was thinking about this as well. It was in the paper about 5 years ago. It was really interesting. To me, it was really interesting. These two dentists, so the local, like Toronto area, so all their dentist practice money was all in the corporation. And so what they did to cover their cost of living was actually they lived off their HELOC. So then they're not paying income. They didn't pay income on the money they're taking from their home. But I don't see why this wouldn't work as well for a cash value insurance policy.
Yeah, it worked. I would argue it worked a lot better because you're guaranteed. So let's run through a kind of quick example for a business owner.
Yeah.
So business owners typically on that first 500,000, depending upon what province you're in, you're going to pay roughly 12% tax, right? So we call those 88-cent dollars.
Yeah.
You pay
One of the best tax breaks we get as Canadians.
100%.
Yeah.
So if I'd taken that dollar as income, well, I would have paid 50% tax and I'm left with 50 cents.
Mhm.
So we go, well, what would you rather, 88 cents or 50 cents? Well, I'll take 88 cents all day long.
Right.
That's one of the few things you still have going as a business owner. So that's a 76% increase in value. So that's cool. So business owners go, okay, I've got some surplus cash now in my corporation. Ideally roll it into a holdco, but we'll forget about that for now. So they say, great, I want to keep 88 cents. Now I'm going to invest it. So they invest it. Now, business owners are typically investing for something fairly safe and short term because they're not worried about, next year could be a down year and I need money.
Mm-hmm.
So if you put it in
And
something,
they usually want something low headache. Yeah.
yeah, low headache.
Yeah.
Because, I always tell business owners, you have enough risk in your life. You've got 90% of your net worth tied up in a small business. If you had 90% of your wealth on one stock in the S&P 500, people would say you're risky. Well, you're not on the S&P 500. You got a little business in Hamilton. Like you've got enough risk. So they invest this money in something safe, and now they've attracted multiple levels of taxation. They're going to pay upwards of 50% tax on the growth. Then what if they want to spend it? They're going to have to dividend out and probably pay another 40% tax to get it out of their corporation. What if they die? Well, it's got to be taxable when they die, and then the kids are going to pay, or they're supposed to pay tax to get it out of the
But
corporation.
they still assets, including the business.
Yeah. And then they have this passive income thing that if you make more than $50,000 a year in passive income, they think you're too rich, even though politicians can have 100+ pensions. And they go, oh, you're a too rich business owner. We're going to reduce your small business deduction.
Yeah, the
So,
business owner is rich, not the politician with a gigantic pension.
so we take, let's say that last 100,000 of retained earnings, and instead of paying it out and be 50 cents, we leave it in the corp and we go, all right, why don't we put this in cash value life insurance? The growth is going to be completely tax free. If the corporation, so that's why I buy my real estate in my holdco, where I borrow from my cash value and I buy in the corporation. So those loans are completely tax free. The death benefit is completely tax free and can flow out through the capital dividend account to my family tax free. There's no tax slip. There's no reporting to the government you even have this. So there's no passive income problem. And then, do you remember our retirement strategy? We do this for the next 20 years as a business owner, growing our cash value, continuing to grow tax free. I needed to make payroll next year, no problem. I needed to buy my competitor, buy my building, whatever. I can use it 10 times. I hit retirement. And now we have this corporate asset of huge cash value. And we go, well, Darren, what do I do with this now? Well, you can actually get a personal loan on that corporate owned policy. Now, again, you got to deal with someone that knows what they're doing, because you get a lot of people that don't know what they're doing in my industry. But if you can get a personal loan on that corporate asset, so in that same example, now corporate policies tend to be oftentimes bigger. If we get a couple $1,000,000 of cash value now, we put in, 50 grand a year for 20 years, we get through in $1 million, accrue to two. Now we're going to take a $200,000, $300,000 loan each year, or basically like a line of credit. You don't have to take the same amount. Use that tax free in retirement. And now say the death benefit's $6 million. Well, the death benefit's going to be paid tax free to the corporation, flow out tax free to the, let's say, spouse in this case, or the family. They're going to use that money to pay off the loan. Again, I'm simplifying it here. There's some things you got to make sure you're doing right. And then you still have millions of dollars left over to pay the taxes on the real estate, to pay the taxes on the business. Now what you've accomplished is you've paid your roughly 12% tax on that dollar, and you've never paid tax on that dollar again. You grew it for 30, 20, 30, 40, 50 years, because it keeps growing when you're retired. You used it 10 or 20 times to multiply the value of your net worth through your business. You've retired on it tax free, and then the death benefit makes everything go away. A lot of people have problems at death, but my experience is if there's a big bag of cash, a lot of these problems can go away.
And then just selfishly, we have a mutual client I was just talking with yesterday. He's getting his policy set up, and then there is interest on this money you're borrowing. So his plan is to, I'm gonna guess it's his holdco. You probably know better, but one of his corporations, he's a doctor, he has corporations. One of his corporations will hold this policy, and then that policy is going to be funding his real estate investments. And then, I can't reiterate it enough to people. Your the better your portfolio cash flow is, the better. Like your real estate, because there still is interest to be paid on this. And even before we're recording, like it's kind of like my own policy. Like I would never invest in something where my interest payment is more than my cash flow on the investment.
Yeah.
Right. It's just you're just asking for trouble. Right. It's like like, and we're talking about like borrowing on stocks for whatnot. Like to me, like who in their right mind would pay like say 6% on to borrow money to buy stocks, unless that stock's dividend at least covers your interest expense. So I don't see why people wouldn't do the same for their real estate. That real estate needs to cover. And then naturally, where do you find better cash flows? Generally, the states. And we actually had a lot of people from your podcast reach out to me after
Oh,
that
good.
episode. Yeah.
Good. No, I was really, check out that podcast on Control and Compound with Irwin. It was fantastic. We had great feedback on that.
Oh, thank you. I'm
Yeah.
glad to hear. I'm glad to hear. Always love to do just to be contribute and help out the community.
Yeah, I mean, that we like, same as us. Like we call ourselves financial educators, right? Like no one wakes up in the morning and goes, you know what, man, I think I'd like to buy life insurance. I just got a hankering for life insurance, right?
Mhm.
So, our pitch is, we've got books. I wrote a couple books. We got free webinars. And then when someone books a meeting with us, we call it a financial education session where we just educate people on the topic.
Mm-hmm.
You like it, we'll educate you again in another session.
Mm-hmm.
And then at the end, if people want to buy, great. If they don't,
Mm-hmm.
we don't pressure people. But my experience is once people get this, once they catch it, it's pretty hard to uncatch it.
Mm-hmm.
But I wanted to go back to business owners because I talked about ideally in your holdco. And like again, I go back to this is all we do. We specialize in this across the country. But I see it set up so wrong for business, often wrong for business owners. And it's because, oh, the guy does everything and goes, oh, I can do this for you too. And if you set it up in your operating company and you leave it there long term, you're just setting yourself up for disaster. Because let's say we set it up in the operating company and then in 10, 15, 20 years, you go, I'm going to go sell this operating company. Well, who wants to buy this company with a massive policy on you on it? A, then your whole lifetime capital gains exemption is going to evaporate because now you've got non-active money in there. Okay. Um, you're you're going to have to move that policy to another corp or yourself individually, and now that's going to be a taxable disposition. So you can set it up in the opco for a couple years, but you've got to have a plan to have a holding company at some point. And you'd be amazed of the business owners that set it up incorrectly and had no idea because
Yeah.
their advisor had no idea.
Yeah. Yeah. Because again, there's not many people that advise at that level when they're that big. And also, I just want to clarify as well. Like, I have lots of clients who have corporations they used to invest in who don't necessarily own a business. They're just
Yeah.
high income individuals. Like they could be VPs or like like there's a lot of people in insurance make really good money, so naturally they have corporations for their investment. But they're essentially a business owner, and when you're saying business owner, they're kind of the same thing.
Yeah, 100%. So again, if you're paying that small business tax rate on that 12%, if you only have a real estate holding company and you don't have that lower tax break, my story doesn't fit. And in those people, I always say, should I do if I just have a holding company to hold my real estate, should I do it corporately or personally? And I'm like, well, where do you have the money? If you have personal money, do it personal, corporate, do it corporate. But if you're actually own a small business, a CCPC, Canadian Controlled Private Corporation, where you're
Mm-hmm.
eligible for the small business tax
Mm-hmm.
rate, it almost always makes sense to do it inside your business.
Mm-hmm.
And even existing policies, when we meet with clients, they might have a couple million a term because they have income properties. They could have $10 million of term insurance because they got a bunch of income properties and they're paying that personally.
Mm-hmm.
And now, again, not huge premium on some of these terms, but as you get older, it can get up there. And I'm like, well, why isn't that in your holding company? So you're using those 88-cent dollars instead of 50-cent dollars to pay that. It's like, well, I didn't know I could do that.
Mm-hmm.
Yeah. So let's slide those in your holdco. And then, what most of our clients experience and I experienced is nothing wrong with term insurance. There's a need for it, especially if you have outstanding mortgages and all that. But I've got 9 of these policies. There's no limit on how many you can have. And I've got a lot of cash value every year I put into this. And I got to a point where my death benefit didn't start small or didn't start big, but it got to a point now where it's quite massive.
Mm-hmm.
So I was actually able to eliminate a bunch of that term insurance
Mm-hmm.
because my dollar was doing another job.
Mm-hmm.
And that's what we always say. If you can multiply the jobs your dollar's doing,
Mm-hmm.
my dollar was in the policy growing. It was in the real estate. I was getting all the jobs real estate does. And it was setting up my retirement and it was continuing to compound and the death benefit was continuing to grow and the death benefit get to a point and I go, oh, I was able to make $2,500 a year term insurance.
Mm-hmm.
So again, multiple dollars doing multiple jobs. That's how we act like the wealthy.
So I have a question that's completely unrelated to everything. I just think that you're highly qualified to answer this. Well, I mean, not qualified, but I think you definitely have thought about this a lot. Like take for example, I think Warren Buffett's leaving 10 million for each of his kids, something around that. I believe Oprah is leaving an absurd amount of money for each of her dogs in her will when she passes. I know some highly successful people who are leaving their kids nothing. Where do you fall on the spectrum?
That's a great question. That's actually a timely question. We
Did you mention you have 9 policies?
Yeah.
That sounds like someone's getting a bunch of money.
Well, it's funny because my son works for me, and so he gets to see my policies now. And I said to him, I go, son, don't get too excited. Your mother and I plan to spend most of this money ourselves.
Ah,
And that's
okay.
really the difference of
Yeah.
this cash value. You buy term insurance, you buy it for someone else. You buy whole life for you and your spouse.
Okay.
So, if I leverage this in retirement, because I plan on being in a 0% tax bracket in retirement, real estate refinancing and cash value life insurance. I want to be in 0% tax bracket.
Mhm. Yeah, you have no
So,
intention of selling these assets.
no,
Yeah.
so the real estate assets I have now, I'll refinance. The cash value I have now, I'll stop doing deals at some point,
Mhm.
and I'll leverage that. I'll be in a 0% tax bracket. So yes, there's still going to be death benefit left over, but a lot of that I'm going to spend in my lifetime. You can effectively spend your own death benefit. Now, technically, you're born against the cash value.
Yeah.
So that would be answer A. And answer B, we're actually launching in the next 2 months a book and a course just on what you asked about
Yeah.
leaving money to kids.
Yeah.
It's a legacy planning course, and it's basically trying to teach kids about money and values. So we're actually going to have a course and a book where we teach kids about values,
Love it.
because nobody wants to leave rich, spoiled kids behind.
Nobody.
But if you can instill your values, you can instill your characteristics, and then we've got stuff on trust that you can set a trust up so your kids can only spend the money you want.
Mhm.
And basically, it's what would the Rockefellers do, because the Rockefellers, you know, John D. Rockefeller left all kinds of money to his kids, but he had it in a trust, and they could use it basically to do what we do: invest in yourself, business, and real estate. And now, fast forward, that family still gives $50 million a year to charity, and there's 200 descendants living off that trust. But they have to pay it back. Every single one of them needs a life insurance policy on cash value life insurance policy. So when they die, it gets paid back into the trust. Now, again, in Canada, you got to be really careful about the trust, which we won't get into today. But the key is if you have a lot of wealth, you've got to design what the kids can use it for. So my kids are great kids, so I'm hoping they continue to be great kids. But yeah, that's a concern for a lot of people. But I think this legacy planning course, that was basically clients were asking us kind
Yeah.
of the same question you
Yeah.
did is, no one left me anything. I don't want to leave my kids a bunch of money and them just blow it. Well, that's what the Rothschilds did.
Yeah.
They had all kinds of money, and all of a sudden, in 50 years, it was gone. They were effectively billionaires in the 20s, and now it was all gone in 50 years because there was no structure when they left that money, how it could be spent. And that's why we spent 6 months working with accountants and lawyers across the country, designing these trusts to be operating the right way, to leave that legacy the right way.
That's super cool. Because I talked to my rich friends about it as well. Like there's a book called I think it's like Die with Zero,
Yeah,
something like that. And I've had friends who were left significant like millions of dollars, and it ruined their lives.
100%.
Right. And also at the same time, I've seen people who've done wonderful things with family legacy and built bigger businesses and uh, make massive donations to charity and whatnot as well. Like I've seen both sides.
Yeah, and I think it really comes down to back to that financial education. If while you're alive, if you can talk to your kids about money, teach them about money. Like I meet with clients' kids all the time, and like this is what you got to be doing, and like get them to buy in young. But then also properly structured trust when you're talking a lot of money,
Hmm.
where no, you can't just buy fancy cars and do this. If you want to borrow money to start a business, cool. You want to borrow money to buy real estate investment property? Great. You want to borrow money to improve your skills, your education? Cool.
Hmm.
But you can't use the trust to go buy a Ferrari. So that's what the Rockefellers did, and that's what our legacy course is
Hmm.
kind of going to be on, about teaching people how to set this up properly.
A friend of mine was making fun of me because I'm a frugal person by nature. Uh, he was saying to me, "Oh, you gotta live a little. You gotta spend it all. You gotta spend more, and Die with Zero book." And he said he gave me an example. Like, how would you feel if your son, after you died, and your son bought a Lamborghini? I said, I would shit. I'm already dead, but
Yeah.
and that was his point. Like, don't leave them too much.
Yeah. But I look at this the other way to say, okay, so if I've got $1 million in my RSPs, and let's assume my spouse is deceased, and I leave that to, this was actually a real world case. I had a client come in, 72 years old. His wife is deceased, and he goes, I got $1 million, and I'm going to leave that $1 million in RSPs to my 4 kids. 250 grand each. I said, cool. No one told you how it works, right? And he goes, no, what do you mean? I go, you're going to leave 540,000 to CRA and 125,000 each of your kids.
Right.
CRA is your largest beneficiary because when you die with an RSP, that is a fully taxable thing. You made 100 grand that year, you made 1.1, and you're going to pay 53 and a half in Ontario, 54 in Nova Scotia, roughly 50% in most provinces.
I don't think most people know that.
No,
It's
they
deemed disposition
they
of
don't know it.
whatever the amount is when you
So
die.
when people say I don't want to leave my kids money or too much money, I go, okay. If you had a choice between leaving it to the CRA or your kids or charity, tell me which one you'd like to exclude.
Yeah.
So I go back to that business owner where we grew that cash tax free. We used it for business growth and real estate tax free. We spent it tax free in retirement. The death benefits tax free. Flows out of the corporation tax free, paying off the loan, and then either charity or children. Would you rather that, or would you rather pay tax all along to the CRA and then die and owe a boatload of tax, and then have your kids have to have fire sales on the property to pay the tax bill? So I always choose family and charities over CRA.
Right. I was just thinking about RSPs are what, from the 70s? Was that when?
Yeah, late 70s, early 80s when they really got popular.
Right. When was the first? When did it first
I
exist?
think it was early, maybe early 70s, but it really, the baby boomers are the ones that took off in the late 70s, early 80s, and the stock market gets sexy because a lot of corporations moved away from defined benefit to defined contribution pension plans and RSPs.
Just a quick history lesson for those for the listener who's not familiar. Like, just not many people had money, like back then. So there were, first of all, there weren't savings, let alone investments. And we were talking about like why won't more people know about this? Well, it's because it's really largely the banks that have promoted RSPs to us and mutual funds, right? And now today we have all sorts of stock brokerage, like online brokerages and whatnot for stocks and whatnot. But these insurance companies have been around way longer.
Yeah. I mean, we've got one that's been around longer than Canada. It actually started before Canada was a country.
Yeah.
Canada Life. Canada Life as a whole life fund started the year before Canada was a nation,
Right.
and they've paid a dividend each and every year.
Since then?
Since then.
Since the 1400s?
We've got two other companies at 150 year or 1800s. Two other companies for 150 years, like World War One, Depression, World War Two, .com, '08, you name it. Like '08, all the whole life funds we use pay dividends of 7% and change when the stock market was down 40. So, again, I believe you've got to be in control of a portion of your money to be able to take advantage of opportunities.
You don't necessarily do this
emergencies.
everything with,
No.
don't put all your money into this.
And I believe if you want to make money, you invest in yourself, a business, and real estate, and some other hard asset. That's real. That's what, it's not rocket science. How do wealthy people get wealthy? You look at every wealthy person, and I bet you every wealthy person either did something to make themselves better, invested in a business or started a business or invested in real estate. That's going to cover 99%. We've got the lucky sperm club out there that might be, the other 1%. But we have new wealth coaches at Control and Compound go through this exercise. Go think of every wealthy person you know. How did they become wealthy? And it all goes back to invest in yourself. Maybe maybe you're becoming a surgeon or a lawyer, not a basket weaving degree, or you joined a real estate group. You got a coach. You did something in real estate where you didn't do it on your own. You brought someone in to help you to learn the industry, or you started a business or invested in a business, or you bought real estate. That would cover almost every wealthy person in Canada. But I go back to the bank. So now we're going to say to a 30-year-old successful entrepreneur, or real estate investor, or 20, 40-year-old, doesn't matter. You know what I think you should do? I think you should take your money, give up control of it, put it in a nice balanced mutual fund with the bank and an RSP, and leave it there for the next 40 years until you're 71. And then cross your fingers, we'll turn it into a RIF and we'll give you a little bit back each month. And hopefully it's enough to get by. Like, I think that's ludicrous when we talk to real estate investors and business owners. Again, you want to be a teacher, throw an extra $100 in, government worker, have at her. But traditional financial planning, that's basically half my book on why it's failed a lot of Canadians, especially real estate investors and business owners.
Now, guarantee usually scares me when people say guarantee.
Sure.
When a company can pay dividends for that long, you can't fake paying people money
Yeah, well,
for that long.
but there's even more guarantees that. So 150 years of paying a dividend. Okay, that's pretty cool.
Yeah. Yeah.
Okay.
How did they do it? How did they do it?
Well, the cool part is, they invest a little bit in the stock market, but they invest fair amount in real estate. They do a lot of private lending. They do infrastructure projects like the 407, the bridge to PEI. They'd actually do farmland, timber leasing. So they're investing money in the long term, because the cool thing of the people that manage these whole life funds is they're investing for 100-year horizon. They're not trying to make their bonus next quarter and they've got to do some crazy thing where they try to get a return to make their bonus. They're investing in the long term. And when they look at someone like you, a healthy individual, they're like, we've probably got 50 years before we need to pay a death benefit out. So we can do some of these longer term projects. And then remember, when everybody borrows against their cash value, well, that interest gets paid back into the fund that we all own. So that is like a guaranteed, 7% right now, that is getting a return in the fund. So you start adding all these up. But the dividend is one aspect. But even if the dividend didn't get paid, which has never happened, the 4 companies we deal with ever, there's still a guarantee you can't go down, and there's still a guarantee your cash value will go up. Now, we explain that to people and they're like, it's guaranteed to go up 100%. And then you have to say, but we've never actually used that guarantee because it's always paid a dividend. And that's a pretty good track record since
Interesting.
150 years.
Now I want to give the listener like a goalpost. Like, for example, like as much as you and I like real estate, it's very safe, high probability of success. There's still ways to fail in it. Excessive vacancy, tenant takes you to cleaners, over leverage. What are like the where can this fail? Where does this not work out?
Too many loans for expenses, and not paying back the loans in the early years. Those are kind of the three things. Like,
So you're bleeding money somewhere and you're over leveraging.
yeah, like it goes back to, if you're not saving $10,000 a year, I don't think this is a great strategy for you. I don't want to be borrowing to go buy groceries. Like there's some people that have 47 loans outstanding and they borrow to pay their monthly bills, and they borrow to pay this and they borrow to pay that. You know what? Some
This ain't
people
for you.
some people can pull
Yeah.
that off.
Real estate investing for you.
My experience is most people can't.
Yeah.
So instead of using it for expenses, I want to use it for opportunities.
Yeah.
So I call it my opportunity fund. It's a lot sexier than emergency fund. And people say, well, how much do I have to put into this? I'm like, well, nothing. But how big of an opportunity do you want to take advantage of? And that's why those business owners typically are taking, they have bigger opportunities. And, it's funny. The easiest people for us to deal with, we love dealing with everybody. But when a wealthy individual comes in, they don't have any preconceived notions about traditional financial planning and RRSPs and that are going to be the way to go. Because if they're wealthy, they have already figured out that's not the way to go, because that's how they became wealthy. It's the people that go, well, my parents said an RRSP is what I should be doing. And I'm like, well, great. If that's for you, wonderful. But if you want to invest in yourself, business, and real estate, you need to be in control of a portion of your money. And if you don't believe that, maybe you're not a good fit.
I was also thinking of, again, my mind often goes back to real estate, because I know some people who've done reverse mortgages, for example. Like typically they're retired, no more income, or their credit's that bad. This sounds like a better option for them.
Yeah. I mean, so again, we talk a lot about cash value, and we talked a little bit about death benefit, how it pays off the loans. But let's use me as an example here. I'm going to have millions of dollars death benefit. Okay. Increasingly millions as I get older. Okay. So at 70, getting a mortgage or a line of credit against my house doesn't sound something like I'd want to do. But wait a minute, it's just another asset. So what's to stop me in retirement to say, you know what? I'm going to borrow an extra $50,000 a year, not reverse mortgage, but line of credit against my house, to top up my retirement income, my tax-free loan income I'm already getting, my refinancing income I'm already getting from the properties. I'm going to take an extra 50 grand a year and just have a fun vacation fund with that. And okay, and I die at 80, and now I owe, say, $600,000 against my house. Well, you don't want to leave your spouse with a mortgage, right? Oh, but wait a minute, I'm going to have $5 or $10 million of death benefit. So it gives you that permission slip to spend your other assets differently. So if you've got a big death benefit, you can say, oh, well, maybe I'll spend, if someone sells their business, maybe they can spend what they make over their lifetime instead of just living off their interest. So they can spend 2 or 3 times as much, knowing if they die, their spouse and kids are going to be fine because there's a big death benefit.
Mhm.
So that death benefit, people don't get excited about it in the early years. They
Mhm.
think, oh yeah, whatever, I'm buying it for the cash value. Trust me, when we start getting into retirement planning, that death benefit is going to allow you to literally double or triple your retirement income at the same time reducing your risk, because you're not taking extra risk to get a greater return. You can just spend your money differently
Mhm.
because if you go into an asset and you take a loan against it, there's going to be something to refill that bucket at death, literally a death benefit.
Now, you mentioned coaching a couple times, and in the real estate industry, there's a massive number of coaches to choose from. One thing I don't like about the industry is many of them have very limited experience. Some people have taken like a course for like 12 months and they bought one property and now they're a coach. Now, are you comfortable talking about strategic coach?
Yeah, sure.
Can you let the listener know? Because I think most people don't even know what strategic coach is or Dan Sullivan.
Yeah. So strategic coach, Dan Sullivan, the founder years ago, started strategic coach, and really it's a coaching group for entrepreneurs. So there's a bunch of different programs in there. So I come up to Toronto. Again, you can go to Chicago, you can go all over the world, different coaching groups. And it's really, you get together in a room with 25 other entrepreneurs or so, and you spend 2 days working on your business, right? We all hear, I'm working in my business too much. I'm not working on my business, but just creating those structures on how to grow your business. So I'm in the 10X program on how to 10X your business, and it's been so incredibly impactful to us. And I go back to the same I tell people in the real estate: find a coach that has done this for a while and has the experience. And Dan Sullivan, probably in the entrepreneur, be the number one coach in the world, and he's got a whole team of coaches
Mhm.
that work with him now. But that ability to get away from the day-to-day stuff of your business and get away and just plan your business, like, what is your goals? Do you want a self-managing business? Do you want a 10X? Do you want lifestyle business? And just actually making those plans. But again, I've had coaches throughout my business career and real estate investing career. Um, and Tom Brady had multiple coaches. Aaron Rodgers has multiple coaches.
Yeah.
And then Joe Blow out there thinks, I don't need a coach. I can do it. And I say, get a coach. It's worth the money. We had a 24-year-old client once go out, join a real estate group, get a real estate coach. Coach, you'd know. They bought a 14-unit building their first year with this coach at 24 with none of their own money. Now, you tell me, what kind of return is this guy going to have over the next 30 years of his investing career to learn that stuff in his 20s?
Mhm.
So I'm a big believer, and I don't care if it's a personal trainer, a real estate coach, an entrepreneur coach.
Mhm.
It's been incredible. We're also doing EOS, which I learned about from Strategic
Yeah.
Coach, really,
Yeah.
because 80% of do what the wealthy are doing. All these wealthy guys in my class are doing EOS. I should investigate EOS, and now,
Entrepreneur operating system.
yeah, and that's been instrumental in growing our business and getting right people in the right seats.
Yes.
And so it all comes together. And the cool part is, all of them are business owners, and most of them are real estate investors. Because again, that's where the wealthy individuals
Mhm.
have made their money. So to get together with a group of people that you can share your stories with, sometimes as an entrepreneur, you feel, I can't really talk to my, T4 buddies about this and this.
They don't want to talk.
So it's nice to have other real estate investors and business owners in a room that you can say, like, holy crap, this happened. Like, what do you guys do here? What do you
Yeah.
do for a cyber attack? What do you do
Yeah.
for,
We're in the middle of a trade war. What are you doing?
yeah.
Right.
So
You
it's,
can't talk to T4 people about
and
that.
this is just coincidence, and I don't mind sharing this because Dan shares it. But he grew Strategic Coach in part by borrowing against cash value. And Babs, his wife, was on a podcast recently. I heard her, and she said, if we didn't have that, we wouldn't have survived,
Yeah.
because that ability to get loans as a business owner to grow your business without going to the bank, or to survive the tough times, or when they started out.
I remember I saw a talk with the founders of Degrassi, and they had to go get second mortgages more than once to make payroll. right? Yeah, the cash value would have been cheaper and more flexible. Yeah. Not everyone's a business owner and like can appreciate like going to the bank. I need a second mortgage to make payroll. Like what an awkward conversation.
Yeah. And there's so like and I'm amazed at the people that have, they fail in one business and they're successful in another, or they've had such lean times, but they get through it and then they become so successful. And again, it's hard to relate to non-entrepreneurs of what
Hmm.
that's like.
Hmm.
Because if you're an entrepreneur, you've had good times and you've had bad, and being able to share those stories and how to deal with them and how to plan for them so they don't happen again,
Hmm.
which again, I go back to my 2008 origin story is I have enough cash value that we're making pay. When COVID hit, that was the first thing I met with the team and said, "Don't worry, you're all getting your paychecks." Like,
Hmm.
and it ended up being a good thing for us
Right.
actually, because people enjoyed doing online business more, which helped to grow our business. But there was a period of time where we were like, huh, so nurses can't do medicals anymore. We can't see people in person. It's been a pretty good run, but what do we do? And then, the insurance companies actually really step forward and allow us. They grew it 5 times the amount of death benefit you could get without doing blood and urine now. So it actually helped our business a lot,
Hmm.
and it helped the ability to do the online business considerably. So again, what could have been a disaster ended up being a great opportunity.
Yeah. Wow. Yeah, 'cause I remember doing my nurse consultation over like something like a Zoom. I forget what it was,
Yeah.
but yeah, I remember doing that. Can I see your ID? Like, hold it next to your face.
Yeah.
um, where can people learn more about this? You offer a lot of education on this already. Can you tell us where people can learn more?
Yeah, so you can go to controlandcompound.com, and then I think in the show notes we're going to put the link tree so you can find out all our socials. But we're on Instagram, Control and Compound, YouTube, Control and Compound. We have a podcast, Control and Compound. We do 5 episodes a month, and then on the website there's links to my 2 books, Be the Bank and Infinite Banking for Real Estate Investors, and those are available on Amazon. And again, we're financial educators. I didn't write the book to make money. I think the Kindle version's 99 cents and $10 for the paperback. But we're huge on educating people on this concept. If you think it's right for you, then you can reach out. We've got a link that you can actually book a complimentary call with one of our wealth coaches. And we tell people up front, we don't meet with everybody. Like if, you know, if you're saving $100 a month and you think you're ready for this policy, we'll have a conversation with you, but it's probably not the right time. And we think we're doing the right thing by those people to say, this isn't right for you because you go in this strategy, you could potentially have problems.
And you're offering free monthly webinars as well.
Yeah, we got a free monthly webinar we started this year, so that's been a big success. You can find the link on the website or it'll be in the show notes as well. And
Oh, I see it on my social media ads.
yeah, and it's cool because who knew people wanted to see me live, but people love the ability to ask those questions.
Yeah.
So we always save lots of time, and we usually have a couple team members on, so we answer some questions in the chat as we go, and then at the end sometimes I'll stop and answer those questions because we tell people if you have that question, chances are another 100 people have the same question.
Mhm.
So that's been a big success. The live webinar, we're going to continue that one a month.
Fantastic. Wow, you put out a lot of content. Any final words? I always like my guests to have say whatever you want to say. Actually, again, so you actually meet with a strategic coach, for example. Like there's a bar you have to get over to be able to qualify to be
Yeah,
as well.
there's like 4 or 5 different bars depending upon what group you're in. Like I don't think the first bar is too high just for the signature program to start. I don't know
Right.
if it's under 200 grand a year as a business owner. I'm not somewhere in there. And then as you go up to the different, there's different, and again, that's just trying to fit you with people that are going to relate to you better.
Yeah.
If you're starting out versus you're a very successful business, and
Yeah.
then they have some I dream of joining someday, very 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 high level stuff. But my favorite thing about Street Coach is trying to get the free days, so you're not working 100% on your business. Because when you're away from the business for a day or two, you're a better business owner. So that's been really cool. So final things, the other
Yes.
yeah.
Yes.
So I would go back to, people ask me all the time, where should I invest my money? Where should I invest my money? And as a former financial advisor, it'd be, oh, the stock market historically has performed or this or that. And I go back to, no, the number one thing you should do is invest in yourself.
Mhm.
You are always going to be the greatest rate of return if you can level yourself up. So I think invest in yourself. And then if you want to be wealthy, invest in a business and invest in real estate. I consider that step two. Step number one is, where do you save your money so you're in control? So when those opportunities come up, you can take advantage of them. And that's where we come in.
Right. I think people forget, like, the financial crisis of 2008 was also called the credit crisis.
Yeah.
Like, nothing, you couldn't borrow money on anything except for maybe apartment buildings, but the rest of the stuff, like, you couldn't get a mortgage. So then, like, where are you gonna find resources? People just think, oh, I'll just borrow the money. I'll just relever. I'll just all these people, unfortunately, were just depending on being able to refinance their properties in this current market in order to raise more money so they could eat, pay out their investors, whatever. And that's not a reality of today's market.
No, you've got to be in control of a portion of your money, because there will be financial opportunities and emergencies come.
Yeah. Yeah. And then I know you said you called it an opportunity fund, but one of the first times this concept was introduced to me was my friend's accountant had cancer, and so they swear by these policies because they were able to borrow against it, no questions asked, to take care of business until he passed.
Yeah. And then if you're terminally ill, all the plans we offer too have you can get 25% of your death benefit advanced in your last year. I've actually paid that out a couple times, and you think
No questions asked.
sorry, you get the questions are, if you're terminally ill, they pay out 25% of your death benefit.
Right.
But the unique thing about it is, well, I had to meet with these people to deliver the checks, because when we talk about cash value, but when we pay a check, that's the most important thing we do, right? Because families are going through something, and we arrive
they
with a
need the
big
money.
bag of cash. But twice I've paid it out to the person that's dying, and I was like, oh, I was stressed about the meeting. This is going to be terrible.
Mhm.
And in both instances, it was one of the greatest meetings I've ever had. He knew he was dying, and he was getting this big bag of money that he was going to be able to spend on his grandkids and go on vacation and do all this
Yeah.
cool stuff.
Yeah.
He had accepted the death part. I hadn't. I was like devastated. I was like, oh, this is going to be awful. And it was still one of the most rewarding experiences of my life, to actually pay someone that's dying a big bag of money while they're alive, to say, yeah, have at her your last 6-8 months and do the things you want to do. Now, he was still able to do the things he wanted to do for a period of time, but
Yeah, in my head just flashed the movie Bucket List,
yeah,
because that was literally what happened to them.
yeah.
They didn't have, their time was finite, and so they spent a lot of money on doing crazy stuff. Yeah, I think, yeah, I was just in China, for example, and I remember the vision of Morgan Freeman on the Harley riding on the Great Wall of China. That'll cost you. Darren, thanks so much for doing this. Thanks for coming all this way. And then one more last time, where can people find your information? Controlandcompound.com. It's right actually here for anyone watching YouTube.
Controlandcompound.com. Yep. Reach out, and then books are available on Amazon. Just search Darren Mitchell or Be the Bank. I'd start with Be the Bank if you want to read a book first.
Fantastic. Thanks again.
Thank you.
All right, friends, that wraps up another episode of the Truth About Real Estate Investing show for Canadians. Hope you got as much out of this one as I did. Remember that whether you're just starting out or a seasoned investor, there's always something new to learn, and it's always about building that practical knowledge base that gets you closer to financial freedom. If you found value today, please do us a favor and leave us a review or a rating, share this episode with a friend, or better yet, join our community of real estate investors who are taking action and making moves. And hey, if there's a topic you want us to cover, or have there's a certain guest you'd like us to have on the show, drop me a line. My DMs are open on social media. Reply to this email that this have arrived on. I'm not hard to find. We're all about getting you the unfiltered truth to help you on your journey. Thanks again for tuning in, and we'll see you in the next episode. Until then, stay smart, stay curious, and keep building that future. Catch you later.